not taking the risk. Because what if it works out? What if you are able to become massively successful? And to me, in my head, I see 100% or 100 times more potential in every single one of you guys than you see in yourselves, because I know it's possible with people's lives. I know that my potential right now is 100 times, like, I'm capable of so much shit. I'm only 23 years old. Some of you guys are far younger than me. I know that your guys' future is going to be probably even bigger and better than mine when you guys are 23. Some of you guys that are older than me, you guys might as well start now. You guys already spent 30 years of your life living in regret and doing things that you guys don't even like doing. Who wants to live their entire life waking up every single day, going to a job that they hate, working for a boss that they hate? Fuck those people. Fuck that job, and fuck that bullshit ass environment that you put yourselves in every single day. You guys might as well take a risk on yourself. You guys might as well go through the fucking dirt. You guys might as well put yourself at that rock bottom point, because if you guys do that, and then when you guys are able to make it out, it's going to make your story and it's going to make yourself feel far better. So I just want to leave you guys with that. I know that every single one of you guys has the potential to be amazing and super successful, because I went from somebody that literally fucking hated himself so much to the point where he wanted to end his life multiple times and tried to end his life multiple times. And I'm sure that a lot of you guys have either been in that situation before or have thought about being in that situation before. And I can promise you it's not fucking worth it, because this is the only life that you have to live. So you might as well make the fucking most of it, and you might as well do what you fucking want to and ball the fuck out. I love and appreciate you guys. Catch you guys in the next one. Peace out.
Mulai dengan solusi Google Cloud, lalu akses langsung ke kredit gratis untuk seluruh penggunaan produk.
힘이 많아서 식도류가 잡았다는데 내려올 때 더 잡은 거여야 돼.
Inflation from
You can make
from China, potential for a contraction in economic growth. Where does the inflation pressure come from?
Yes, that's also a big good question. I think the inflationary impact will only come if EU is ready to retaliate. And I think that's the key risk, because then you will actually see the acceleration in core goods, which is actually absent in terms of inflation in Europe right now. So for us, the inflationary impact is kind of limited, but it's limited to how EU responds to tariff policy. But I think one thing also we could get inflation back to Europe is how this fiscal policy works, right? Germany is going strong with the fiscal reforms. We don't know how it's, at this stage, it's just one of the ingredients towards growth, but does it have an inflationary impact? I know it's a medium-term question, but when it comes to ECB members, they need to put everything together when they are forecasting their inflation.
Pooja, here in the US, we talk a lot about a divided Federal Reserve. They meet next week. There could be some dissent. On this governing council, how united are they?
I would say a bit more than Fed. I think there is general unanimity about that the policy is in a good space, and I think they still are waiting. And I think you can see in terms of general data, we are holding up well. I know France is the weaker spot when it comes to Europe, but other nations are still doing well. So I don't think that there's that much juggle within the committee as we have seen in Fed or even in the case of BOE. So I think making decisions seems much more simpler for ECB. And primarily because disinflation came in very easy for Europe. It wasn't a task, as we are seeing in both US and UK.
Pooja Kumra of TD Securities. Pooja, appreciate your time. Thank you. 200 basis points of cuts from the ECB in the last year or so, and they hit pause. That word pause, though, they might avoid that word. They might prefer the word skip. They want to be agile, nimble, open-minded about the future. They seem to avoid the word pause, don't they?
Right now, traders are picking up on that, and they are still pricing in about 22 basis points of rate cuts for the remainder of this year. The expectation that sometime in the fall they'll resume it. This is the first pause, or skip, I should say, the preferred rhetoric coming since July of 2024. So a notable departure as they assess the landscape.
What's the landing zone for the ECB? They're at 2 already.
Good question.
What are they coming down to?
Is it 175? What is the bigger risk? And where is the inflationary pressure coming from? Is it truly retaliation, as Pujo was just saying?
You can see this disinflationary shock building from the policy front. I don't know what's going to happen in the future, but that's the direction of travel at the moment.
I'm looking for where the inflation is going to come from. And if it doesn't come from China, it doesn't come from a stronger currency, it doesn't come from reaccelerating growth. The only thing that could potentially be is if some of the industrial investment starts to pick up, but we haven't seen that being particularly inflationary either. So very curious how she's going to answer that question.
A news conference with Christine Lagarde, the ECB president, 20 minutes away. Up next, breaking jobless claims data here stateside. We'll catch up with Nita Richardson of ADP here to react from New York City. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The opening bell's about 60 minutes away. Your scores look like this. Equity futures positive by 0.1% on the S&P. 3-day winning run coming into Thursday. It's a series of all-time highs. On the Nasdaq 100, positive by 0.3. The economic data just seconds away. Check out the bond market. 2-year, 10-year and 30-year bond yields look like this. Yields higher by 2 basis points. 440 on 10s, on 2s up a basis point. Just short of 390 at the very long end of the curve. Your 30-year at the moment is up 3 basis points to 496.36. Let's get you some economic data. Let's kick it off with jobless claims. That data hasn't dropped just yet, but the estimate we were looking for was 226. It's out now at 217. The previous week was 221. 217 is the right kind of downside surprise, and jobless claims have just hung in there, haven't they, over the past few weeks?
So anyone looking for the bad news to start showing up in the number of people filing for benefits after losing their jobs, you're not going to find it here. Pretty much across the board, you can see initial claims 4-week moving average moves lowered 224,000 rather than staying at the 220, almost the 230,000 from the prior week. There just is a question here. Are we not seeing something? Has the labor market changed? Right now, the market is seeing, honestly, that resilience feeding into the ongoing strength that so many people are pricing in the equity market.
There are subtle signs, though. Continuing claims are still elevated, and this has been a theme now for a number of weeks, and we've talked about this. If you're without a job in America right now, it's getting harder and harder to get a new one.
I'm glad you mentioned this, because actually continuing claims did go up from the prior week. So exactly counterintuitive to what you had been seeing at the highest right now going back to June 20th. So still not necessarily going through the roof, but still the sense that you're right. It is definitely a stagnant market, and you're not seeing that activity really pick up.
Let's catch up with Ira Jersey of Bloomberg Intelligence. Ira, welcome to the programme. Next week, the Federal Reserve will put out a statement. In the first paragraph of that statement reads, the labour market or the economy is solid. They use this word solid. Can they keep referring to it as solid?
Well, I think when you have data like we had this morning, you could certainly make that case. I do think that they'll probably moderate that slightly, just because when you look at the payrolls data, you know, it was good, but it wasn't great. And you do see some of the details make things look not quite as strong as they had been in the recent past. But the job market still is not an impediment to the Federal Reserve keeping rates on hold, right? Like if the Fed really wants to cut rates, they kind of need to hang their hat on something. And it's not yet inflation, and it's not yet the jobs market cracking. So I'm not sure if you could really make the case that the Fed needs to be cutting right now, just given the incoming data.
Governor Waller might make that case next week. He might dissent. Others are saying they'll be on hold all year. Bank of America, Morgan Stanley. We spoke to Mizuho earlier this morning, Ira. Jordan Rochester said you can price out the cuts in 25 and price more in 26. What matters here is Chairman Powell is going to be replaced. What do you and the team think about that?
Yeah, well, I mean, Chair Powell, one way or the other, is not going to be the chair come next May. I think the question is, does he leave before that, and you know, firstly, and secondly, is he going to have continued angst from the administration, where the administration continues to say that rates need to be cut and cut more quickly? But again, like from an economic perspective, that doesn't seem to be the case right now. And I do think that the Fed will probably cut this year, but not until the very end of the year. And that's been our call since February, because the incoming data that we have now, you really need to see it slip over several months for a bulk of the committee to cut. Keep in mind, even if Jay Powell were to leave today, you still have other members of the committee and a bulk of the committee that still thinks that the Fed needs to be on hold for this year, or it will only cut once or twice. So you still have relatively hawkish, compared to what the administration wants, members of the committee overall.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. With us around the table, Nita Richardson of ADP. Nita, good morning.
It's great to be here with you.
It's good to see you. Let's talk about this jobs data. We've heard a lot from a lot of people who say this labour market is no longer a reason to be hawkish. Is it becoming a reason to be dovish?
I think you can't say that this labour market's not in transition if you look at the last 3 months of hiring. They're slowing. It's clear. And so whether hawkish or dovish, the labour market is an issue on the table to consider. And I think when we look at next week, which will be jobs week, we'll see a continuation of a slowing trend. And I'd like to mark that trend with something that you can see clearly in the ADP data. The slowdown isn't coming from goods. It's coming from services. And that is the turnaround in the labor market. It has been that services have held the water for the labor market. It's really the goods sector that's suffered. And with tariffs in play, still, you would think it would be the goods sector that is bringing down the momentum. It's not. It's services, which points to a whole different case study on what's really going on in the U.S. economy.
So talk us through what that case study is in terms of, are we just seeing the cycle shift from goods to services, but goods hiring will pick up significantly, or does this speak to a broader type of trend?
You know, there's so many megatrends right now. And I like to look at the first 6 months of 2025 and compare it to the first 6 months of 2019 before the pandemic. This was actually inspired by something Jonathan said about getting a pay raise. Because if you look, I thought it was a great question. I wasn't satisfied with my answer, so I went to the data. And it turns out that there hasn't been an increase in new hire average pay in over a year.
Wow.
$18 it's been. And that's because the supply and demand dynamics have held firm. It's a really balanced labor market. I think it breaks because we're seeing lower supply. The labor force participation rate now is lower than it was 6 years ago. There are fewer people working and looking for work, and that's what's going to keep pay a little bit higher or a little bit more stable for new hires than it was 6 years ago.
So this raises a really good, interesting question. Even if we get numbers that look pretty good on the jobless front, not that many jobless claims, on the job creation front, more than some people would expect, is there anything about this labor market that's inflationary with wages increasing?
Well, this is a very deep labor market. We talk about whether it's solid. I think of it as deep. Still waters run deep. And what you're seeing is that, yes, if you look at job stayers and job switchers, which we look at all the time at ADP, pay growth is elevated. But when you look at those new hires, they're pretty stagnant. And I also look at the job openings by the U.S. government, which shows 500,000 more jobs now than there were 6 years ago. But the hiring rate, the rate at which employers are hiring is lower, 3.4 in May compared to May 2019, 3.8. There is less urgency to fill those positions, and that's what's leading to this no hire, no fire stasis in the jobs market. I think it breaks because of labor supply issues, not necessarily labor demand issues.
Governor Waller was sitting in your seat last week, and it seemed to really weigh on him, the unemployment rate on recent college grads, 7%. What's going on? Why are they not able to get a job?
Well, I think it bends back to the data we just saw. Continuing claims. It's harder to get a job in this labor market where supply and demand are in balance. And for young people coming out into the market, this is not their older brothers or sisters' labor market. In 2022, they were snatched right up. They have that expectation. Their older sister told them that they were snatched right up, and that was the expectation. It's not that labor market anymore. It's a labor market that requires patience and networking. It's Gen Z. It's going to take a little bit longer. And where these college grads are coming out is what exactly is slowing. Professional businesses, services are slowing down. Finance is slowing down. If they were coming out in construction, I think they would see that kind of snatch up in the labor market, but they're not seeing it now.
Neela, it's great to see you. Thanks for breaking it down. Appreciate it. Neela Richardson there of ADP. Jobless claims are holding on, but the rest of the labour market just starting to crack. Some fragility there starting to brew. Just slowly, but you're seeing it.
Well, you're just seeing just not a lot of motion. In fact, that the ongoing, continuing jobless claims is so high and going higher tells you a lot. What Neela was saying there is fascinating, the idea of what kind of wage growth are we seeing? And you're seeing wage growth actually decelerate in Europe. At what point will that justify in its own right what the Fed decides to do if they decide to cut?
That decision a week away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump is heading to the Federal Reserve today to tour the construction site he is criticized for cost overruns, as the renovation is estimated to cost $2.5 billion. Trump could use any evidence of mismanagement or fraud related to the renovation as a pretext for removing Powell. Meanwhile, take a look at Alphabet shares. They are rising 3.8% in the pre-market after its second quarter sales beat estimates. The company said it's raising capital spending by $10 billion to $85 billion this year, citing rising demand for cloud and AI services. Google is weaving its flagship AI model Gemini into its product portfolio as it confronts competition from Meta and Microsoft. Meanwhile, American Airlines shares are falling 6.5% in the pre-market. The company reported second quarter earnings that beat analyst estimates, and it reinstated its full year guidance. But it said possible scenarios range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents a share. American also forecasts a third quarter loss exceeding analyst estimates. That's your Bloomberg Brief. John?
If you don't guide confidently right now, you get absolutely punished. Yahara, thank you. Saw that earlier this week as well, didn't we?
Yeah, pretty much. That seems to be the way forward. I mean, Texas Instruments, the idea that they talked about, we're not sure if this is just a pull forward. And those shares were down something like, what, 12% in pre-market trading before the open?
They got hammered. This stock's getting hammered too. Up next, Terry Wiseman of Macquarie, plus ECB President Christine Lagarde, her news conference moments away.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
The opening bell about 47 minutes away. Equity futures unchanged on the S&P. If you check out euro-dollar, the euro negative, the dollar stronger. The data in America okay. Jobless claims hold on. The ECB and that news conference just moments away. We can catch up with Terry Wiseman of Macquarie. He joins us around a table. Terry, good morning.
Good morning, John.
This from Deutsche Bank just moments ago. Mark Wall, the question is, will this be a short pause or a long pause? How are you thinking about this ECB meeting?
Well, you know, the statement seemed to suggest that the ECB is still very data dependent. But I want to broaden that definition a little bit to suggest that it's not just about the data that's going to come out. There are a lot of crosswinds, obviously, besides the data going on with the EU, and tariffs is that biggest crosswind, right? we don't know what the deal will be between the U.S. and the EU, and I presume that even before any data that emits from that deal will become known to the ECB may have to be forced to make a forward-looking decision based on what that deal is. Now, the ECB has been very plain, I think, especially if you read between the lines. Maybe plain is not the right word, but you can certainly infer from what they've been saying that if the only thing that happened was that the U.S. imposed import tariffs on the EU and the EU did not retaliate, that would be disinflationary for the EU. It might be inflationary for the US, but disinflationary for the EU. So if we do get those 15% or 20% or maybe even 25% or 30% if there's no deal, I think that the EU will see that, the ECB will see that as disinflationary, and it may compel them to cut again, even if the data is lagging. On the other hand, if there's retaliation, right, well, then it's not as disinflationary for the EU as they may have presumed, and maybe they'll do nothing. So, you know, I have to interpret what she's saying very broadly here to include what's going to happen on the policy front with tariffs. Having said that, I suspect that she's going to reiterate today that the ECB is in a good place, that 2% is neutral. And of course, when you have inflation running at 2%, that implies a real interest rate of 0, effectively, which is probably not that different from the per capita growth rate of the EU. And it feels like the right number.
It's interesting listening to you talk about trade. As that news conference gets underway in just a moment, we'll head over there in a second. You're talking just about the agreement between the EU and the US. And I wonder whether for the Europeans, the more important agreement is between the Chinese and the US. Because if the walls go up here, they've got to eat the Chinese exports.
Right. So there's potentially another source of disinflation in the EU. If the walls do come up here and the Chinese are unable to sell product into the US, obviously they'll be forced to dump their products into the EU. But effectively, it's the same situation as the walls in the U.S. being built up against the EU. If the Europeans can't sell product into the U.S., they're forced to redirect those products into their home economy. That will be disinflationary there. So effectively, anything that builds walls around the U.S. imposes some disinflationary pressure on the rest of the world, almost no matter where you happen to be.
Given all the potential disinflationary forces, is Friedrich Merz going to go down to Frankfurt and try to get Christine Lagarde to talk about her renovations and what this means about why they should cut rates sooner?
No, I don't think so. I think what's interesting about the ECB and the nature of the governance of the ECB, where there is all these countries that are represented, means that it's very, very difficult to impose, for a head of state to impose their will on the governing council. It's a very different structure than we have here, right? You have, and of course, you know, some people complain about that from time to time. They'll say the EU is inertial, in part because you have to get agreement from so many countries to do some things. But in some cases, that becomes a good thing, right? You can't have one head of state doing what he wants and imposing his will on a presumably autonomous agency.
The Treasury Secretary said it. They've got a collective action problem. That's what he said to you just yesterday. Terry Wiseman of Macquarie. Terry, thank you, sir.
My pleasure.
The news conference in Frankfurt is underway. The pause has started. How long will that pause be after cutting interest rates by 200 basis points in a little more than 12 months? Let's take a listen.
The economy has so far proven resilient overall in a challenging global environment. At the same time, the environment remains exceptionally uncertain, especially because of trade disputes. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. In the first quarter, the economy grew more strongly than expected. This was partly because firms front-loaded exports ahead of expected tariff hikes, But growth was also bolstered by stronger private consumption and investment. Recent surveys point to an overall modest expansion in both the manufacturing and services sector. At the same time, higher actual and expected tariffs, the stronger euro, and persistent geopolitical uncertainty are making firms more hesitant to invest. The robust labor market, rising real incomes, and solid private sector balance sheets continue to support consumption. Unemployment stood at 6.3% in May, close to its lowest level since the introduction of the euro. Easier financing conditions are underpinning domestic demand, including in the housing market. Over time, higher public investment in defense and infrastructure should also support growth. More than ever, the Governing Council considers it crucial to urgently strengthen the euro area and its economy in the present geopolitical environment. Fiscal and structural policies should make the economy more productive, competitive, and resilient. Governments should prioritize growth-enhancing structural reforms and strategic investment while ensuring sustainable public finances. It is important to complete the Savings and Investments Union and the Banking Union following a clear and ambitious timetable, and to rapidly establish the legislative framework for the potential introduction of the digital euro. The Governing Council welcomes the Eurogroup's commitment to improve the effectiveness, quality, and composition of public spending, and supports the efforts by European authorities to preserve the mutual benefits of global trade. Annual inflation stood at 2% in June, after 1.9% in May. Energy prices went up in June, but are still lower than a year ago. Food price inflation eased slightly to 3.1%. Goods inflation edged down to 0.5% in June, whereas services inflation ticked up to 3.3% from 3.2% in May. Indicators of underlying inflation are overall consistent with our 2% medium-term target. Labour costs have continued to moderate. Year-on-year growth in compensation per employee slowed to 3.8% in the first quarter, down from 4.1% in the previous quarter. Combined with stronger productivity growth, this led to slower growth in unit labour costs. Forward-looking indicators, including the ECB's wage tracker and surveys on wage expectations of firms, consumers, and professional forecasters, point to a further decline in wage growth. Short-term consumer inflation expectations declined in both May and June, reversing the uptick observed in previous months. Most measures of longer-term inflation expectations continue to stand at around